Welcome to Beavers Wealth Management's January 2025 edition of Let's Talk Markets. It's our goal to continue to grow Let's Talk Markets with the intent of educating and empowering the families and businesses we serve. So if you know of anyone who may find this information valuable, please feel free to share it with them. And welcome back to Let's Talk Markets. As we kick off the new year, we're diving into what makes 2025 an exciting time to be an investor. And our goal today is simple. We want to share lessons, insights, and strategies that will help you navigate the markets with confidence. At Beavers Wealth Management, we believe that looking back is just as important as looking forward, because it's about learning from the past to build a stronger financial future. And so we truly appreciate you joining us today. And so let's get started with a recap of 2024. I'm kind of calling it a year full of surprises, resilience, and valuable lessons for every investor. So as we look back on 2024, I can't help but reflect on how the year surprised even the smartest minds in the market. At the start, expectations were low. But once again, the market showed their resilience and the ability to defy predictions. And I believe looking back isn't just about reflecting on the past, it's about learning the lessons we can carry forward to make better decisions in 2025. And so today, let's dive into what 2024 taught us, the moments that mattered, and then how we can use those insights to navigate the road ahead. All right, so let's get going. Starting off in 2024, it was about low expectations, right? The top Wall Street strategist anticipated a modest 1.9% gain for the S&P 500. I mean, just look at the graph here. The most bearish outlook came from JP Morgan. That's the world's largest bank with access to an infinite amount of resources and some of the smartest minds. They projected a target on the S&P 500 of 4,200. And they cited factors like lackluster earnings growth of around 2 to 3%, rising geopolitical risks, and softening economic demand. Let's not forget, the presidential election was also expected to introduce uncertainties that many claimed would be negative for stocks. But overall, expectations for 2024, they were unusually low. Wall Street certainly didn't see much in 2024 following the strong year that we had in 2023. But it didn't take long for the bears to be proven wrong. Goodbye bear and hello bull. By the third week of January, the S&P 500 reached an all-time high for the first time in 2 years, marking a 38% rally from its October 2022 low. This surge occurred without a coincident recession, demonstrating that the stock market doesn't always mirror the economy. That's important to remember, especially as we go into the next couple of years. Despite the market's rebound, the mood was far from rosy, right? With some fearing a potential double top and doubting the strong start to the year. But by the end of March, the S&P 500 had already surpassed all but one of Wall Street's year-end predictions, rising to 5,254, and you can see that here on the graph. The unrelenting rally continued in the second quarter, and the S&P 500 ended the first half of the year at 5,460. That's above all Wall Street's year-end targets, up 14.5%. So you can see that the expectations from what we thought going into this year and what we saw just in the first couple of quarters kind of blew away everything that was anticipated. The gains continued not only in that first 6 months, but even in July. And by early August, it seemed like nothing was going to derail the move higher. But just when you least expect it, that's when the market tends to throw a curveball. And we saw that. We call it Black Monday in Japan. On August 5th, Japan's Nikkei index experienced a sudden 12.4% drop. That was actually its second largest single day decline ever. combined with the losses from the previous session, the Nikkei was down 17.5%. That's in 2 days. The market was down 17.5%. That actually surpasses October 1987, the crash to become the largest 2-day decline in its history. So fear then started to get into the market, right? It was that the fear of that unwinding carrying trade spilling over into the US markets, causing the volatility, or what we call the VIX, to spike to over 65, its highest level since March of 2020. So we saw that volatility index. Remember March 2020, the beginning of COVID, when the markets were going crazy during that period of time. We actually experienced a little bit of that whenever we saw Japan's markets take that correction. Now, despite a near 10% correction in the S&P 500, the market then rebounded swiftly, reaching new heights thereafter. Kind of thinking about it, I don't know how many of y'all actually knew or remember that during last year because markets were so good, but we saw a 10% decline during that period of time. That was a decent sized correction, but it happened so quickly and moved on. A lot of people kind of forget about it. All right, so then what happened? All right, so we experienced the Black Monday, if you will, for Japan. And then it was all about the Fed easing again, right? We talked about this in previous Let's Talk Markets at the end of the year. After aggressively tightening policy in 2022 and 2023, they raised the Fed funds rate by 525 basis points. Unprecedented how fast they did that, right? Well, they finally started reversing course in September of 2024 with a 50 basis point rate cut. They also implemented 2 additional 25 basis point rate cuts in November and then in December. So they brought the Fed funds rate down to a range of 4.25% to 4.5%. So that was in basically a 4-month period of time. We saw a 1% decline in the Fed funds rate. Pretty significant when you look at how quickly that happened. Now, while short-term bonds like the 3-month Treasury bill followed the Fed funds rate, lower longer-term yields, they actually moved in the opposite direction. The 10-year Treasury ended the year at a yield of 4.58%, up from a low of 3.63 in September, and actually it started the year at 3.88%, marking the highest year-end level for the 10-year Treasury yield since 2006. That's before the financial crisis. So what was the bond market saying to the Fed toward the end of 2024? And I think this is what it said. I think it said, you may be done with inflation, but inflation is not done with you. And the road back to the easy money policies and monetary policy of the past, it ain't going to be an easy one. Well, did the Fed get the message? I mean, perhaps, right? In the 2024 projections that they came out with, the Fed actually revealed higher expectations for inflation in 2025, 2.5% PCE, and a fewer anticipated rate cuts. Now, if you go back to our Let's Talk Markets, this is what Beavers Wealth Management had been talking about all last year. We didn't think it was going to be this significant rate cut environment that the market was anticipating, and we thought we'd be in a higher inflationary environment for longer. We've been saying that all throughout last year. Finally, the market woke up to that at the end of 2024. And then the expansion continued. The recessions that many predicted at the start of 2024, well, they never arrived. Real GDP in the US, it came in above 3% annualized in both Q2 and Q3, exceeding the expectations of nearly all of the economic forecasters. And what was the biggest factor kind of helping the economy afloat? Really, it's kind of the big factors that always keep it afloat. It's continued strength in the labor market, with job growth in every single month of 2024, and now, believe it or not, 48 months in a row. This is actually tied for the second longest streak in history. All right, so that's where we arrive at Ryan's market fact for this year, or for this particular Let's Talk Markets. And what we're calling it is extremes across the investing landscape in 2024. And so one of the things he noticed is we saw notable disparities between a number of areas of the markets. Growth versus value, for example. Did you know that growth stocks outperformed value stocks by almost 20% in 2024, following a 31% outperformance in 2023? That's the biggest two-year outperformance of growth over value in history. We're making history here, y'all. Large caps versus small caps. Large cap stocks, they outperformed small cap stocks by 13% in 2024, following a 9% outperformance in 2023. This was the biggest two-year outperformance of large cap over small cap since 97, 98. We're getting retro with this. Market cap versus equal weight. The S&P 500 outperformed the equal weight index by 12% in 2024, after a 12% outperformance in 2023. This is the only consecutive years with a higher combined outperformance than 23-24. You want to know when that was? 1998 and 1999, right? During the tech bubble. Those were the only 2 years that had better performance during that period of time. And I don't know if we even want to go into US versus international. It's not pretty. US stocks were up 25%. They outperformed international stocks, which were only up 5%. That's 20% difference in return in 2024. And that's the biggest outperformance actually since 1997. US stocks, they continue to outperform international stocks now. 16 years. 16 years. Domestic has outperformed international. That's a long time. And now a lot of this we know is the Magnificent Seven stocks, right? They continued to shine in 2024. You want to know how much NVIDIA was up in 2024? 171%. You can see it here on the chart. Good Lord. You can see all of the Magnificent Seven returns compared to the S&P 500 or the equal weight index on this chart. Over the past 2 years, these 7 companies have significantly outperformed the S&P 500 and its equal weight counterpart. And their dominance has actually increased their representation in the index, with over a third of the S&P 500 now concentrated in these 7 stocks. That is the largest share for any 7 companies in the index on record. A little scary too, right? 7 stocks represent a third of the S&P 500 index. You got to be careful. All right, so to conclude the year, S&P 500 ended the year up over 25% on a total return basis. That was the second consecutive year with a return above 25%, and that's something that we haven't seen since 97, 98. What propelled the U.S. stock market higher? Earnings and expectations. The S&P 500 operating earnings rose 9% during year-to-year record highs. Expectations for future growth are also high, with the S&P 500's PE ratio now 36%, above the historical median since 1989. The S&P 500 would end the year at 5,882. That's a far cry from what many of the analysts predicted at 4,400, besting every major Wall Street firm's price target by over 400 points. Even on the highest one, the S&P 500's actual price gain of 23% was over 21% higher than the average forecast. Whew, a lot happened in 2024. It's important, as I said, to kind of take a step back and look at what's happened there, but it's only beneficial if you take that and then you have investing insights on the lessons learned moving forward. And so what did 2024 teach us as investors, and what can we take into 2025? So I wrote down a couple of things here. 5 key takeaways from this. First one, the market doesn't follow predictions. At the start of 2024, the consensus among top analysts suggested a modest 1.9% gain for the S&P 500. And the market defied those predictions, rallying to new all-time highs. Right? So what's our key takeaway from this? Forecasts are helpful, but they shouldn't dictate your investment strategy. It's better to focus on owning great businesses for the long term rather than trying to time the markets based on predictions. All right, number 2, the resilience of the market. So despite geopolitical tensions, rate cuts, and a volatile August, the market rebounded strongly and ended the year on a high note. Key takeaway from this, the market's resilience highlights the importance of staying invested during periods of uncertainty. One of my favorite sayings is time in the market often beats timing the market. That's number 2. Number 3, focus on fundamentals over headlines. With significant divergence between growth and value stocks, which we talked about in Ryan's Market Fact, as well as large cap and small cap performance, and even the Magnificent Seven dominating returns, it raises questions about market concentration. Key takeaway from this is, rather than chasing the hottest stocks or sectors, which is all too easy to do, stick to the fundamentals. Look for companies with strong earnings, durable competitive advantages, and reasonable valuations. Number 4, the importance of diversification. The concentration in the U.S. large cap stocks, particularly what we talked about in the Magnificent Seven, they've outperformed other asset classes and geographies. We know this. However, this high concentration at historical levels that we've seen is just in a few stocks. It dramatically increases the risk associated with, just buy the market, buy the S&P 500, something many passive investors may not be aware of. And so the key takeaway from this is diversification is your friend. Diversification across asset classes and geographies helps reduce risk and capture opportunities in different economic cycles. All right, and the final point that we have in Lessons Learned, prepare for the unexpected. From August's sudden market volatility to the Fed's policy pivot, 2024 reminded us that markets, they're unpredictable. Key takeaway, always have a margin of safety in your portfolio, right? And you can do this a number of ways. This may mean holding cash or bonds or other defensive assets to weather unexpected storms. Because storms do come, and we'll see storms again. And so what do we make of all this, right? 2024 taught us that long-term investing, it isn't about reacting to the noise, but staying focused on enduring principles. So Warren Buffett, which everybody knows, right? He advises that the stock market, and I love this, is a device for transferring money from the inpatient to the patient. I love that. The stock market is about transferring money from the inpatient to the patient. And moving into 2025, let's carry forward these lessons. Investing with discipline, staying diversified, and keeping a long-term perspective. Because whatever 2025 may bring, Beavers Wealth Management is here with you every step of the way. And we're not just here to answer questions or analyze market movements. Our commitment is to work alongside you, ensuring your financial goals stay on track and adapting as life evolves. Together, we'll face the opportunities and challenges of 2025 with confidence, optimism, and a clear plan for the future. And that's why we offer our second opinion service. If you or someone you know could benefit from a second set of eyes on their investments, we'd welcome the opportunity. Ensuring that you're in a good spot with your investments and for the people you care about, that's our top priority. And we're here to support you and those important to you every step of the way. All right, in conclusion, so much covered today, right? Well, we took a deep dive into 2024, its surprises, key market lessons, and how those insights can guide us into 2025. Lots of numbers, lots of information, but a great way to start 2025 with a look back to 2024. I want y'all to know we're so grateful you joined us today, and we encourage you to share this content with anyone who might find it valuable. We actually have all the replays of Let's Talk Markets. They're posted on our new YouTube page, and the video podcast format is also on Spotify. YouTube and Spotify are also home to episodes of our new podcast called Between the Bears and the Bulls. And thank y'all, by the way, the positive feedback we've received from our first few episodes in 2024, it's been incredibly encouraging. And we're excited to bring you even more insightful conversations because that's what that podcast is all about. It's conversations. So stay tuned for upcoming episodes featuring inspiring guest stories of excellence coming very soon. Enjoy the start of the new year, and we'll see you next month for February's edition of Let's Talk Markets. Oh, and before we go, here's one for the road. I had a friend that was thinking about going into business and opening his own distillery. But as a financial advisor, I told him it would be a whiskey investment. Don't forget, leave it to Beavers.